Hello and welcome, everybody. Let me get a little bit more light in here. Welcome to another Sectors Made Simple webinar. I'm pleased to be here with you all after a great week in the market and the end of one of the best months that we've seen in almost 2 years. July was a very positive month for the market, despite some less than positive economic outlooks, or rather numbers. So today, I wanted to continue the trend that we've had the past few weeks of looking at economic data. We gained a couple of new pieces of information this week that I want to review with you all, and then, much as the name suggests, we're going to look at Q2 earnings. We're going to look at how those earnings have affected the stock market, and also why those earnings have caused more of a commotion than investors really expected. So, all that today and more as we review Q2 2022 earnings, how those earnings have impacted the stock market, and where our economy heads starting into August. So, hopefully you all are ready for the ride. We have lots of data to go through, lots of charts to look at, and lots of lessons to learn. So, let's get straight into the action. So, welcome to our Q2 2022 earnings season webinar. The disclaimer here is pretty important. I will be doing quite a bit of forecasting today. I've gone through and looked at a ton of data. I've looked at a ton of analyses that are studying the current state of earnings, and I've done my best to get as much data as I could, and not just one opinion, but as many opinions as I can to provide you all with the best well-rounded perspective of where we are in the market. But as we'll talk about in a little bit today, estimates and forecasts, regardless of how big the company or how many resources they have to dedicate to it, are never perfect. Past results can never guarantee future performance, and all forecasts are just that. They are best guesses that we only have until we get the real numbers. And as we'll look at today, sometimes those real numbers are pretty far from where the estimates peg them. So, please remember today is all about sharing information, not about forecasting, and take everything today as educational resources. So, now that we've gotten the disclaimer out of the way, let's talk about the goals for this webinar. This was a pretty wild week for the stock market and also for the economy. There was a lot of things that happened, and not all of it was positive. So, it's not really a question on everyone's mind is still, are we entering a recession? This is a topic that every single person you ask will have a different answer. Actually, before we get anywhere, before we talk about data, what do you all think? If you're in the chat right now, let me know. Do you think that we are entering a recession? Do you think we're already in a recession? Or do you think we're going to avoid a recession? If you're watching this recorded, please feel free to put it down in the comments below. It'll be very interesting to see how time moves on and see how close we were to having the right answer. Again, we never will know the right answer because we're living history as it's written. The best we can do is study what's happened and try and forecast what might happen in the future. So what do you all think? Do you all think that we are entering a recession? I think we dipped our toes in a recession. Not quite yet, but I'm watching every dollar spent. That is feeling a recession. Again, there is a big difference between the technical definition of a recession and feeling a recession. And I've long said in the past few months that you will feel a recession sooner than a recession will be announced. And that is extremely true. Paulina is saying we are entering a recession. I'm not going to give my opinion because you will learn my opinion through today's webinar, but all of those statements so far are all completely accurate. We all feel like the economy, not the market. The economy is entering a recession. But as Kike just pointed out, Jerome Powell, as everyone calls him, he announced that he doesn't think we're in a recession, and he thinks that a recession can be avoided. Who's right? Who's wrong? Only time will tell. But we have some numbers to try and give us a better idea. So in this webinar, we're going to review all of this information that I have put together for us. We're also, yes, going to talk about the ongoing Q2 earnings. The earnings season has just begun, and we have gotten some really big companies' earnings this month. And those earnings have had a pretty sharp change, or have caused a pretty sharp shift in the stock market. So we'll get to look a little bit closer at that. So let's get straight into it, shall we? There were two major events that we gained this week, and one slightly smaller one. But all of them are important for giving us the answer, or helping us get closer to the answer of, are we in a recession? So we saw two major events this week, and then also one minor release this week. First, the FOMC meeting on Tuesday and Wednesday. This meeting announced a new increase to the federal funds rate, and that was a very important announcement, and we'll talk about why when we get to that. But the second was that we got Q2 of 2022 GDP numbers. The BEA, the Bureau of Economic Analysis, is a government organization that is responsible for providing us with data, information on the US economy and the stock market, although they focus mostly on the economy side of things. So they released their Q2 2022 real GDP numbers, and we'll take a look at what those are. But if there was one major event that people were following this week, it was that. Because GDP is the thing that the normal, not expert person is going to look at to see, are we in a recession? It is the technical definition of a recession is 2 GDP quarters of losses. But a recession is not a black and white thing, as we'll talk about later. So it'll be very interesting to see what numbers those BEA announcements pegged GDP at. And finally, the small one on the week, the CMDI, this corporate bond distress index that we talked about in last week's webinar. We did get their July numbers, and we'll review those as well. So all three of these events will help us to answer the question, or at least get closer to the answer, are we entering a recession? Let's start with the small one. Let's start with the CMDI. So CMDI, we first saw last month. In June of this year, the New York Federal Reserve began tracking a number that they call the CMDI. The goal of the CMDI is for us to be able to understand the bond market and understand how stressed out it is. For lack of a better term, it is how stressed it is. The higher the index, the more distress there is in that market. I don't think you need me to tell you that distress, uncertainty, and volatility are less than optimistic things for the stock market. Last week, we looked at this CMDI, and we looked at where its June numbers were. We only get 1 month of data at a time. So while last week was in the middle of July, we were still looking at data as of late June 2022. So we saw that bond distress was definitely increased, mainly for investment grade bonds, but that rate was increasing, and we said it's too early to tell anything, we need another month of data. Well, this week we got that other month of data. So let's go take a look. We see now that the bond distress represented by these three lines, the market group in blue, the investment grade group in red, high yield in yellow. These three groups are trending upward. Now, investment grade continues to be the most elevated, with a CMDI index of over 2 times what the other markets are at. Now, this is high. In fact, it's about as high as 2011 and 2016, two of the highest spikes that we've seen since the recession, the Great Recession in 2008. Now, we are still below where we saw these indices when we were in recessions, but it is a very, very clear statement by the bonds market that they are starting to get worried, and that something might be happening. Now, this CMDI shows that it is continuing to rise. Investment grade bond distress is at those elevated levels that we saw in 2011 and 2016. Pardon my ignorance on the topic. What exactly is investment grade? Amazing question. There are groups that are supposed to rate bonds. These ratings are a way for investors to know risk versus reward. So when a bond is rated, it is given a rating based on its likelihood to pay back those debts in a timely manner. If you have a very, very strong, reputable company, that bond rating will be much higher. There's a higher likelihood that they will pay back their bonds, which means they are going to pay out a little less because there's less risk, so a little bit less reward. Then, as the ratings get lower and lower, we will see that rating, or we'll see the likelihood drop that they pay back, but in return, we see the increase in yield rates. Now, let me actually find a table because it'll be easiest. It'll be easiest to show you a table of it because investment grade is on a scale. There is investment grade and then non-investment grade, or what can be called junk bonds. So let me just pull this chart up really quick. Each group that looks at bond ratings will have a slightly different scale, but here's a good rule of thumb for them. Any ratings above Baa3, BB minus for both Standard & Poor's and Fitch, anything above that is considered to be investment grade. Anything below that level is considered to be non-investment grade or junk bonds. So when we're looking at, if I go back one slide, if we're looking at this, the high yield bonds are going to be those junk bonds because in return for having more risk, they also have a higher yield for that high risk, high reward kind of opportunity. Then our investment grade are those higher rated bonds, representing companies that have an extremely high likelihood of paying back their bonds. Now, if you want to see something really interesting, back here in late 2011, this was a period that the reason that the bond ratings increased was that the US bonds, the treasury bonds, actually got downgraded. So there was concern that US treasury bonds were not going to be able to pay back their yields. That is the reason that we saw this increase, was panic around the fact that there was a downgrade, one of the few downgrades we've ever seen for US treasury bonds. So when we're looking at this, we got to say that as there's more distress in these large institutions, these large companies that are issuing investment grade bonds, that is a sign that investors are getting a little bit worried about these large companies being able to have a constant flow of revenue to pay back their debts. So again, what we're seeing here is these bond distress levels are high, and they're as high as they've been in the past 15 years that didn't yield a recession. But I still think that we're short of danger territory because we're still well below the levels that we've seen before and also during recessions. Additionally, we are only seeing the investment grade at that high, almost dangered level. Both market and junk bond yields are still holding, they're elevated, but they're not at holy cow, we need to be panicking levels of elevated. But again, this chart is one piece of information. It is not the Bible. It is not perfect at telling us what is really happening across the market. It only looks at one section of the market that the stock market doesn't really cover. So it does give us another piece of information. It is another equity market, or sorry, securities market, but it is not exactly one that is flawless. And again, we only have 2 recessions worth of data. This number only goes back so far, and it only goes back to 2005. So it's hard for us to know exactly how true all of these levels are when we don't have a sample size to be able to provide much history. But it's a piece of information that, when used in context with other pieces of information, gives us a more well-rounded base of knowledge. So for another piece of information, let's go look at probably the most well-recognized indicator of a recession, GDP. Quarter 2 GDP was the big talk of the town because quarter 1 was negative. And this Thursday was the BEA's announcement of those quarter 2 numbers. Prior to that announcement, which was the current knowledge of what we have, the Atlanta Fed has what they call GDP Now. It is a rolling estimate of where the Atlanta Federal Reserve Branch believes GDP is for that quarter. It is forward-looking, so in quarter 2, they are estimating quarter 2, and in quarter 3, now, they're estimating quarter 3. So up until the announcement, the Atlanta Fed estimated that the quarter 2 GDP was going to be negative 1.5%. Meanwhile, blue chip companies, these major institutions, when I say blue chip, we're referring to major established institutions. These are the big dogs. These are the big fish in the pond. They are supposed to be the ones that have a great idea of what's really going on. They have the most resources, the most data. So the Atlanta Fed tracks what they think as well. Most blue chips estimated quarter 2 estimates around 1.5 to 2.8, positive 1.5 to 2.8%. To show you what that looks like, I went to Wayback Machine and grabbed the estimate for the end of quarter 2. We see those blue chips here converging. They're all starting to get more and more in agreement of where they think it's going to be, somewhere in this like 2.8% to 1.3% range. Or 1.5%, you could call it. Maybe 1.4%. Meanwhile, the Atlanta Fed's estimates started off positive until the end of June, start of July, where their estimate dropped significantly, down to 2%, and held somewhere in that 1.5 to 2, or that negative 1.5% range. How does this stack up to the real BEA numbers? Well, the Fed was closer, but they were overly pessimistic. They thought it was going to be worse than it really was. Again, they estimated a minus 1.5%. In reality, it was negative 0.9%. Now, that is still negative. That is still a second quarter in a row that GDP has gone down. And that does trigger if we had to have one black and white indicator of recession, no recession, that would be that indicator putting us into a recession. But there's more to it than that. Recessions aren't this black and white yes or no thing. There's a lot of maybe in the middle. And in reality, we live in that maybe. Very rarely can we definitively say yes or no of are we in a recession. So let's look at some data and see what we can learn to gain more information about not just are we in a recession, yes or no, it's all right, how deep are we into one, if we are in one at all. To do that, we get to go consult our friend that has been very close companion for the past webinars and will be a close companion for today. Thank you, St. Louis Fed, for providing us the Fred. What does Fred think, shall we? Shall we take a look at what Fred thinks? What we have here, and I will post in chat because I like providing data, or the sources for the data I provide you. We have a chart for the historical GDP, and we get to look at how the GDP changes have moved through recessions. Every gray line that we see is a recession, and the blue line that we see is the quarter-over-quarter GDP change. So let's zoom in a little bit and see what we can find. I zoomed in too much a little bit. There we go. 2008 was a key recession that we can look at. We saw 1 quarter of GDP losses, a recovery, then 4 consecutive quarters of losses, all through 2009. So late 2008 into 2009, then we saw our recovery here. Note, we didn't get that double period until right here. We didn't get those 2 consecutive quarters of losses. Well, I guess here we did. These would technically be, well, no. These were the first periods where we had losses. This was a decrease in the rate. Looking a little closer at 2020, we basically bounced into one and then out of one very quickly. But that drop was severe because we went from 1.9 to minus 5% to minus 31%. This isn't price here. This is how much stuff the US produced went down by 31% and then immediately bounced back up 33%. Let's look back a little further. Let's now look at the dot-com bubble of 2000 through 2002. What we see here is a similar period of loss, recovery, loss, recovery. There's no 2 periods of GDP losses here. There's drop, recovery, and then we're in and out of a recession. What gives? I thought a recession is 2 periods of GDP losses. Like I said before, there's more to it than just GDP. And that's really what I want you to take away from this. Yes, if all you look at is GDP, we are in a recession. But there's so much more to it than that. And as we see here, there are periods where we were in a technical recession without being that double quarter-over-quarter loss of what a recession by definition should be. Looking back though, here we had a similar thing. Here, that's 2000. Let's look back one more time. We just looked at that one. The 1980s. 1 period of GDP loss, 2 periods of GDP loss. By the time we got that second period of GDP loss, though, we were already moving out of that recession. Here, we did have that double period of GDP loss. So what that's showing us is it an indicator? Yes. Is it a perfect indicator? No. There's so much more to it than just that. And that's really what I want us to take away from this, is that what this shows us is, well, yes, GDP numbers do put us into a recession. There's a lot more information that we should look at. That's not just GDP. Recessions are not this black and white matter, this yes or no answer. That dot-com bubble that we looked at in the early 2000s did not see 2 consecutive quarters of GDP losses, but it did lead to a recession and massive losses in the stock market, especially in the tech-heavy NASDAQ. Let's go look at what happened to the NASDAQ index, if I can actually spell NASDAQ correctly, in the 2000s. We're going to go here. We're going to look at this. We're going to make it bigger. It keeps resetting. So the NASDAQ reached its high here in early 2000. And in 2.5 years, lost about 75% of its value. There was no 2 quarters of GDP losses, but one of the largest exchanges and indices in the US stock market lost 3/4 of its value in 2.5 years. That's substantial. That is a lot bigger than just 2/4 of GDP losses. So what does that go to show us? That there's a lot more to a recession than just GDP. So now we've said what the GDP numbers are. We've said what the GDP numbers are. But instead of just saying where they're at today, I want to show you one other thing that I didn't highlight on the first time we looked at this. I think I'm looking at the wrong chart though. Let me find, this is the one that I want to show you. Look how deep some of these recessions pull GDP. -3%, -1.6%, -8.5%, -1.6%, -31%. Where we are right now, -0.9, is pretty small in the grand scheme of things. It is still a drop, and any drop is significant, but it could be a lot worse. It's weird to say, but it could be a lot worse. And also, it means that the signal of GDP, are we in a recession, isn't as severe as, yep, I just dropped 33%. That's a little bit more of a strong indicator than, well, I'm down, but I was down more last week, or last quarter, as it really is. But now now we've talked about what's happened in the past, what's happening now. Let's talk about what might happen in the future by looking at GDP now. We just talked about GDP now and how its estimates over Q2 panned out. They also, like I said, is forward-looking. We can get information about where they think it's going to be next. So what is the estimates for Q3 GDP 1 month into it? Remember, Q3, we're right now in Q3. We're already a third done with it. Funny to think, we're just getting Q2 data and we're already a third through Q3. That's how it works. The government and companies take a long time to decide how much money they made. What are estimates saying? What is the forecast of where we are going to be in Q3? If you ask the blue chips, somewhere between 0.2% and 3%. If you ask the Atlanta Fed, 2.1%. Now, you're probably asking, we're only a month in, isn't it too early to tell? Yes, it is. But we need something, all right? There's no such thing as bad information. Okay, there definitely is such a thing as bad information, but having more information in this case is not a bad idea. Because really, the reality of the current state of the economy was that the Atlanta Fed moved more and more negative. They were pessimistic. They made things out to be worse than they really were. Now, while Q3 projections are very far out, the fact that the Atlanta Fed is now thinking GDP is going to be positive is a really great indicator. That is a very strong sign that the Atlanta Fed thinks what's happened we are already moving out of, and that we're going to see GDP recover before the end of the year. So that's pretty optimistic, and we did just look at the projections for that. So what does that tell us? That blue chip institutions are definitely more spread than they were for Q2. But they're all mostly of the opinion that GDP will rise in Q3. And the Atlanta Fed agrees. The Atlanta Fed does think that quarter three GDP growth is going to increase around 2%. That is a very optimistic sign. That points to the Atlanta Fed and major institutions believing that if we are in a recession, that we're going to see GDP recover by this quarter that we're already living in. And that both of these estimates fall pretty closely in line with what the FOMC thinks. Remember, the FOMC, the Federal Open Market Committee, we're about to talk more about them, but every so often, every quarter, they release what they call the Summary of Economic Projections. It's a big, very statistic-heavy sheet that the Fed announces what they think different key economic metrics are going to be at for the end of the year. They told us where they think, that's the wrong one. They told us where they think these numbers are going to be. If I pull up the Summary of Economic Projections from last month, down here, change in real GDP. That's the numbers we were just looking at. The range of estimates is somewhere in the range of 1% to 2%. That means all of the people that announce their numbers here, which is every head of the Federal Reserve branches and the FOMC themselves, they all say that GDP by the end of the year is going to be somewhere in the range of 1% to 2%. That falls decently in line with what these estimates by the Atlanta Fed, are saying. While we're here, I do want you to remember one more number. Federal funds rate. This interest rate that sits below all other interest rates. The rate at which banks lend to other banks. Their range for the end of 2022, last month, was 3.1 to 3.9%. The median, 3.4%. Remember that. It will matter in a couple of minutes here. Because now that we've started talking about the FOMC, let's go and talk about the FOMC a little bit more. Because this week, we also had the FOMC meeting. They met on Tuesday and Wednesday, which were July 26th and 27th, to discuss the state of the U.S. economy and also to make some changes to that federal funds rate. One of the main focuses of that meeting, and one of the main focuses of all economic conversations, is inflation. The fact that our dollar is worth a little bit less, or a lot of bit less, every day that goes by. Right now, the current rate of inflation that we have is 9.1%. The Fed wants to do something about that because the inflation rate needs to go down by one of two ways. By choice, with the Fed making changes to the federal funds rate, or by force, with a recession. I'll take option A. I don't know about you all. I would definitely take option A. Inflation is something that affects us all. It's part of the reason that we are so much more aware of our spending and we're cutting down spending right now, is the fact that inflation is putting pressure on us. The cost of things is greatly increasing compared to how much we're making to pay for said things. So we want that to change and we need that to change. And one of the ways the Fed can do that is by increasing that federal funds rate, making money more expensive to borrow, in turn driving down spending. But if they go too far, if they do it too much, they can overshoot what needs to be done and start causing damage. So what they're trying to do is make changes to the federal funds rate to lower this rate of inflation without triggering a full-on recession. That was their announcement. We want to avoid a recession, so we're increasing the federal funds rate. But wait, I thought GDP just told us that we're in a recession. We had 2 consecutive quarters of GDP losses. We're in a recession, right? Right? Well, not entirely. Because there's one big number that has not really changed. And that is the biggest difference, where if you had to ask me, are we in a recession? I would point to a single thing as a point of, well, not really, or it could be worse. Any guesses at what it could be? The cost of my Chipotle burrito? CPI? How about unemployment? Unemployment is probably the biggest difference between historical recessions, periods of GDP loss, and where we are today. I want to show you something. Funny enough, when I found this graph and I put it into the slides, by the way, thank you, Cleveland Fed, the Federal Reserve branches are really helpful at giving us economic data. Kind of neat, right? Gives you a very reputable source to pull information from, and also, they like charts. I like charts. I hope you like charts too. It gives us a way of turning numbers into a picture. Let's see what this picture says. What we see here is the past 70 years of recession and the unemployment rate through that period. Every period of gray, like the other charts we've looked at, are periods of recessions. This data ends in 2020, by the way. Unemployment in the late 1950s recession, late 40s recession, jumped up to just about under 8%. In the next recession, jumped up from around 2.5% to 6%. Hovered around 4%, went up to 7.2%. Back down, back up. If you notice, in every single recession that we've had, regardless of the magnitude, there is a sizable increase, not improvement. Not an improvement, the opposite of an improvement. What is the opposite of an improvement? I don't know, not the point. What we're seeing, though, is that there's multiple percent increases in unemployment when a recession occurs. And in theory, that makes sense. If companies can't borrow money as easily, if the cost of things are going up, companies are going to cut back on their expenses just like we cut back on our expenses. When they cut back on their expenses, one of their biggest expenses are people. They're going to start laying people off to try and cut down on spending and decrease their workforce to meet the demand that people currently have. And it's this constant deprecating cycle. Businesses lay people off, less people have jobs, less people having jobs decreases spending, which causes businesses to make less revenue, which causes them to lay off more people, which causes more people to have less money. It's this constant cycle that keeps going until it bounces down and starts to recover. We haven't seen that yet. Right now, we have not seen these significant changes to unemployment like we have in the past few recessions. Let me see if I can find a chart. I'm sorry I didn't prepare this. All right, that's good enough. We'll take this. This is current as of June. Thank you very much, Google, for having useful graphs. Recession of 2009, unemployment peaked out just at 10%. COVID, a lot of people got laid off. Unemployment spiked to 14.7%. Where's the unemployment numbers? If we are entering a recession, we would already start to see an uptick. Remember, this recession, the recession of 2008, didn't really start until towards the end of 2008. We already saw an uptick in unemployment in that period. So right now, we're still sitting below a 4% unemployment rate. Now, if we were entering recession, in my opinion, we would see this number already be starting to rise. And the fact that it's not is a very nice silver lining to point to maybe if we are in a recession, it's not as bad as it could be, or as bad as some people would like to make it sound. So unemployment is pointing to we're not in a recession, or at least if we are in one, unemployment hasn't risen, and as far as GDP is concerned, all estimates are currently pointing to GDP improving before the end of the year, which if we do see an uptick in unemployment, which if we do see it, don't panic, it's expected when the federal funds rate increases, that we would see this rate, or we would see a deeper recession be avoided. I want to show you one other thing before we get into the world of stocks. Oh, this got out of order. There's this whole thing of certainty. The market likes being certain. Actually, let me go through this slide first, because now we finally get to talk about stocks, and then we'll go back to the Federal Reserve one more time, then we'll actually get into earnings, I promise. What does the stock market actually have to say about recession and decreasing GDP? Funny enough, not very much that's bad. This week and this month in the stock market has been one of the best since 2020. The Dow closed up 6.73% today. SPY, 9.2%. And the NASDAQ, good old NASDAQ, closed up 12.35%. But that doesn't make sense. We got an announcement of negative GDP numbers and an increasing federal funds rate, meaning businesses are going to be not borrowing as much money, or it's going to be more expensive. We saw corporate bond distress increasing. Why are stocks rising? Two reasons. One, earnings. Two, certainty. Let's be honest, the one thing that the stock market hates is uncertainty. They don't like not knowing what's going to happen. This week's announcements provided certainty. With that announcement of that 0.75% increase to the federal fund rate, J-Pow did kind of decrease or assuage. Funny enough, I know what the word means. I know how to spell it. I can't tell you how to pronounce it. But he tried to make investors be a little less fearful by saying that they were going to slow their federal fund rate increases. Part of the reason is that they want to avoid that unemployment rate increasing. There are many factors of a recession, one of which is increased unemployment. Their goal is to make changes to the rate of inflation, but avoid triggering a recession and avoid causing a spike in unemployment. That announcement of we're going to slow our efforts provided a nice sense of relief to investors. Right now, the rate sits around 2.25 to 2.5%, and that's including that 0.75 increase. When we looked at that FOMC projections sheet, that range of where they think the federal funds rate is going to be by the end of the year was somewhere in the range of 3.1 to 3.9%. If we're at 2.25% just past the middle point in the year, and we started at 0% in March, that is definitely a slowdown. That definitely falls in line with what Jerome Powell has been announcing. And also, it is still far below the federal funds rate that we've seen in the past that have been leading up to, might not have been the cause, but have been a large contributor towards the beginning of recessions. Much like most of the data in this presentation, I think it's best shown in a graph. Let's go talk to Fred. Welcome back, Fred. We missed you for all of the 10 minutes that we didn't look at you. All right, welcome back. Now, the chart that we're looking at is the federal funds rate over time. Let's start super far back. We saw a recession in the late 50s with a rate peaking around 3.5%. Then in 1960, we saw a recession begin with a rate around 4%. After that, the number went way up. We saw a recession occur with a rate at 9%, a recession occur with a number at 10%, a recession occur with the number at 17%. How about 19%? 8%. Over here, we saw it spike up to 6.5%, 5%, and then 1%. Although there was a couple of other things happening in the world that wasn't just the federal funds rate in 2020. What's the point of me showing you this? Let me zoom in a little bit also so we can see these more clearly. We're seeing these declines of the federal funds rate coming in a recession. And all of these events are occurring with a significantly elevated federal fund rate. We're seeing most of them occurring, besides 2020, where we know what in the world happened then. I didn't mean to do that. We're seeing these reversals occur well above 4%. The goal of the Fed, the target that the Fed has, if you asked the most optimistic person and the most pessimistic person, the extremes of what they would tell you is 3.1 to 3.9%. So what does that tell us? And what does that graph show us? That we've only really ever seen 2 recessions that occurred with a federal fund rate lower than 5%. And those 2 recessions were over 60 years ago. Since then, we've seen recessions with significantly higher federal funds rate, excluding 2020, which again, couple of things going on in 2020 that weren't involving the stock market or the economy. The federal funds rate, they have definitely tempered how much they use it as a tool because of the severity of what can happen when they are so aggressive with that federal funds rate. That announcement that they are trying to cap out or slow down how much they are using the federal funds rate to reverse inflation is the majority of the reason that the Fed, or that investors have gained confidence through these federal fund rate increases. It's that we are already more than half of the way there, and also they're not planning on taking things too far, at least we hope. So while these rates of increases do seem large, after all, we just had a period of over a year with 0% on the federal funds rate. And by the size, 0.75% is significant. That's the highest we've seen in almost 20 years. They're still dramatically lower than the overall federal funds rate levels that we've seen in the past 60 years. Elizabeth is saying the correction is needed, especially after the big jump in GDP, after the dip in 2020, after all the money that was printed to save the US economy. Definitely. Something to keep in mind though, the main monetary tool that the Treasury Department has is not so much printing more money. Yes, they can print more money, but oftentimes it's using bonds as a way of putting more money in or taking more money out, whether they are sending more bonds out into the market or buying back bonds to try and remove money. Or sorry, opposite. They will try and take in bonds, put out money, or take out money by putting in bonds. So this puts us in an interesting place. GDP numbers say we're in a recession. Jerome Powell says that we can avoid one. Historical numbers for the federal funds rate have shown that recessions typically occur at significantly higher federal funds rates than what we're seeing right now. And investors are enjoying the fact that Jerome Powell has acknowledged that and has said that they plan on slowing their federal fund rate changes for the rest of the year, with federal funds or with the FOMC estimates falling somewhere in the range of 3.1 to 3.9%. Cool. So we just did a 50-minute webinar named, what's the name of it? What we can learn from quarter 2 2022 earnings, and we haven't even talked about earnings yet. Now we can finally talk about earnings. But why in the world did we wait? Because after all, the name of this webinar is What Can We Learn from Quarter 2022 Earnings? Well, it is, but the stock market is not what's moving things right now. It is not a matter of the stock market turning its head. It's the matter of the economy being the neck turning the head whichever way it wants. So we really need to not just think about the market as this isolated thing. Yes, the market cycle leads the economic cycle, but the economic signals and the direction of the economy also impacts the stock market and, more importantly, investor confidence in the stock market. So earnings definitely have affected the price of companies, but it's very interesting to see the real effect that it's had, not just on those companies, but related stocks as well. So let's take a look here at some company earnings, how those earnings have stacked up against analyst estimates, and how their stock prices have changed. I've done my best to distill this down into a list that gives us a well-rounded picture. It is not the best of the best. I tried to give some companies that did really well and some companies that did not do really well. So I can show you a bit of both sides. The way that I've formatted this, is we will see the company's name, the percent surprise. So how off were analyst estimates? Why did Microsoft go up today after reported losses? Great question. So we're going to see the surprise. So how far off of the earnings per share estimates were analysts? And then we're going to look at the price change that stock had. First and foremost, Microsoft. They missed estimates by 2.2%, but their stock rose 6.7%. Google's missed estimates by 4.72%, but their stock price went up by 7.74%. Visa beat estimates by 13.8%, but saw a loss in price. Although there was something else going on. There is a bill making its way into Congress that the bill would target credit fees and would try and aim to reduce credit fees, which would be a pretty big decrease on Visa's revenue. So many financial companies centered around credit markets did decrease this week. So that's the reason we're seeing a loss there. Now on the positive side of things, Coca-Cola beat estimates by 4.5% and a stock price increase of 1.6%. McDonald's beat estimates by 4.1%. Price went up 2.7%. Meta missed estimates by 1.6% and had a stock drop of 5.2%. But this was not due to their earnings so much as it was their sales. Their sales were, for the very first time since they IPO'd, negative. That is a very large event for such a large company. Qualcomm, 3.5% revenue outperformance, but a 4.5% loss due to their C-suite announcing that they expect revenue to decrease in quarter 3 due to poor smartphone sales. And there's many, many more companies. Amazon was another really, really big one. Overall, if we looked at companies that have issued their earnings this week, 73% of companies outperformed the analyst estimates. Now, 73% sounds really, really good. That means most companies, 3 out of 4 companies, were beating analyst estimates. But that's not a record, and it's far from one. But it is a start. 73% would be below the average, the 5-year average, which is 77%. So over the past 5 years, every quarterly report, we have seen an average of that average of 77%. But 73%, the number is not as important as something else. Regardless of if the company's earnings beat or missed earnings estimates, their stock prices went up. Let me show you. Companies with positive earnings so far have seen a 2.9% increase in price. The 5-year average is 0.8%. So we are seeing almost 4 times higher returns for companies with earnings that beat out estimates. How about negatives? How about companies that missed analyst estimates? They've seen a 1.2% increase, 3 times better than the 5-year average of negative 2.4%. So if you miss estimates, the average is 1.2% up. Not down, up. If you beat estimates, the average was 2.9% up. That points to a single conclusion that I can make. Analysts and all of these estimates they provided us with were expecting a horrible season. Every investor was panicking, thinking GDP is down, earnings are going to be down, companies are going to be in the toilet. That didn't happen. Earnings reports were nowhere near as bad as we expected them to be. And regardless of if they beat estimates or didn't beat estimates, the fact that everything was not as bad as we thought it was going to be, we now know and have certainty in what quarter 2 earnings were. Regardless of if you beat the estimates or not, the average has been an increase across the market. If we looked just at S&P 500 companies, though, things take an even brighter turn, where on average, S&P 500 companies that have announced quarter 2 earnings have seen earnings growths of 6% and revenue growth of 12.3%, despite that quarter 2 2022 loss in GDP. Pretty interesting, right? It starts to explain a little bit why we're seeing negative news but positive returns for the stock market. So what do we take away from today? The economy is still very much on the edge of a recession. GDP tells us that we are in a recession, but other key parts of a recession have not been seen. Notably, unemployment. Unemployment still remains unchanged, and the federal fund rate still remains well below the level that we typically see a reversal in a recession at. And all estimates from the Atlanta Fed, from the FOMC, from their summary of economic projections, and blue chip organizations all point to a quarter 3 increase in GDP, implying that things are going to start improving in the near future. The Fed's announcement of that slowed federal fund rate has led to increased optimism in the stock market. And that optimism was further increased by our earnings and revenue numbers for quarter 2, much, much, much outperforming the fear that many investors had over these earnings reports. Are they all beating analyst estimates? No, 1 in 4 companies is not. But on average, even though they're not beating estimates, they are still returning positive price because nothing is turning out to be as bad as we expected it to be. So moving forward, what should you keep your eyes on in the next few weeks? If you're a Sectors Made Simple subscriber, keep an eye on the matrix because we are likely to see some major shifts happening. Right now, we are in a very interesting middle ground in sector rotation. It's going to be very valuable to watch BPI in the matrix and also the matrix itself to see what sectors emerge as leaders, to see if technology, discretionary, and communications rise into sector leadership. Also, it'll be very valuable to keep an eye on these different sector ETF point and figure charts. We should see some price changes where we'll see a lot more companies, and in turn, as the S&P 500 is a very well-performing index at the moment, we'll likely see many sector ETFs going on buy signals. So look for buy signals, BPI reversals, and hopefully a strengthening of discretionary technology and communications on the matrix. For everyone, if you don't have a Sectors Made Simple subscription, maybe consider one. The data is really, really useful, and I do lots more analyses like this in our members webinars. But something everyone should be following is the continued earnings reports. We are at the very beginning of the earnings season, and there is lots more data and much more earnings reports to see. And we'll get to learn a little bit more of if this trend in the market will continue. We all hope it does, and we all hope that Q3 does follow through to meet the estimates that everyone is hoping for. So are we in a recession? Hopefully now you have a little bit more knowledge, so you don't have to take my opinion. You get to form one for yourself. Thank you all so much for joining us today. Thank you for bearing with me through a very numbers, but also graph-heavy webinar. Hopefully you learned something new today, and you understand the market, recessions, and where we all sit with it a little bit simpler. Thank you all so much. For members, we will not have a webinar this upcoming Tuesday. I will be traveling. Instead, I will be back with you all next Friday to take a closer look at earnings and see what has changed. What is my opinion? I think that we are in again, I don't think that a recession is a black and white thing. I think that we have bounced off of market bottom and are starting to recover. I think what we're seeing in the market is the beginnings of a bull market, and bull markets typically precede a recovery period. I don't think we're going to dip into a full recession. I don't think things are going to get much worse than they already are, and I think that we're going to see a lot more positive improvements, especially as we get the rest of earnings reports if they continue to follow suit with what we've seen so far. So that's my thoughts. But again, feel free to share your thoughts in the comments, continue this conversation, and I'll be back with you all next week as we pick up where we left off today and see how the rest or the continuation of earnings season shapes out. So thank you all so much. Have a great weekend.